Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. So, if you're like a lot of investors, you probably spend most of your time watching the U.S. markets, right? The Fed, the S&P, what's happening with AI.
Yeah, it dominates the headlines.
Totally. But you might actually be missing some really big moves happening elsewhere in the world. So today, we're going to deliberately look beyond Wall Street. We've got two, honestly, pretty fascinating global puzzles to dig into.
That's right. And our goal here is pretty simple. Break down these complex global shifts. First, we'll tackle what's going on in Japan. It's really acting like two totally different economies right now.
Oh,
It's quite strange.
okay.
And then we'll zoom out a bit. Look at this bigger trend where non-U.S. developed markets, places like Europe and Japan, are actually starting to show some real strength against the U.S. market, which has been leading for so long. This is, well, it's crucial for how you think about diversification in your portfolio.
Okay, sounds good. Let's dive into Japan first, because the data we looked at, it shows the market doing things we haven't seen in, 25 years?
Yeah, about that. The key thing, the puzzle, really centers on this metric called the NT ratio.
NT ratio. Okay, what is that exactly?
So it's pretty straightforward. You take the index value of the Nikkei 225, that's the big famous one, and you divide it by the value of the TOPIX index, which is much broader.
Nikkei divided by TOPIX.
Got it. And what's really grabbing attention is how high this ratio has climbed. It recently hit 15.8x.
Whoa, 15.8. That sounds significant.
Oh, it is. It's a massive concentration of gains. We literally haven't seen it this high since the peak of the dot-com bubble, back in 2000. It really shows this almost like manic preference for certain stocks over others.
Okay, maybe an analogy would help here. If you think of the whole Japanese stock market as, say, a big luxury cruise ship.
Okay, I like where this is going.
Right. So the NT ratio hitting 15.8 tells us that the super fancy penthouse suites on the top deck, those are like the big Nikkei stocks, they're just speeding away, getting way more valuable, much faster than the rest of the ship, the standard cabins on the lower decks, which represent the broader 2PX stocks.
That's a great way to put it. They're not sailing together anymore. And that separation is super important because you can't just use these indexes interchangeably as a proxy for Japan now.
Right. So they represent different things.
Totally different. The Nikkei 225, it's heavily weighted towards those giant global companies, the big exporters, the tech firms. Think Toyota, Sony, or semiconductor guys like Tokyo Electron, Advantest. It's really sensitive to global trade, currency movements, that kind of thing.
Okay, so Nikkei is global facing. What about TOPIX?
The TOPIX is, well, it's much more reflective of the actual Japanese domestic economy. It's got way more domestic service companies, retailers, and importantly, banks. It's more about what's happening at home in Japan.
And the performance gap really shows that split, doesn't it?
Oh, absolutely. It's impossible to miss. Just since October, the Nikkei index jumped about 4%, the broader 2PX. It only managed maybe 1%.
Wow.
Yeah. And this huge gap, it's not like general optimism about Japan. It's very specific money flowing into very specific places.
So what's causing this extreme split? Why now? Our sources seem to point to like a 1-2 punch. Politics and policy expectations.
That's the first big driver. Specifically, it's about the policies of the new Prime Minister, Takaichi Sanae. People are calling it Takaichinomics.
Ah, okay. Shades of Abenomics.
Exactly. It's a classic example of policy driving market focus. Prime Minister Takaichi has promised, strong government investment, specific support aimed right at certain sectors.
Which sectors?
Again, semiconductors, the defense industry, and anything related to national economic security.
And investors are basically front-running this. They're placing bets now.
Immediately. When the government says we're putting money here, capital just floods into the obvious winners. That's why you see these huge moves in certain Nikkei stocks, like Mitsubishi Heavy Industries or those tech equipment makers we mentioned. They're direct beneficiaries of these expected policies.
Okay, so that's driver number one. Policy bets. What's the second punch?
The second one is just as powerful, maybe more so right now. Currency weakness. We're talking extreme yen weakness. The term is enyasu.
Enyasu. Okay.
Yeah, it just means cheap yen. And it is really cheap. The yen's at a 35-year low against the dollar. It recently crossed 153 yen per dollar.
Okay, but hold on. If the yen is super weak, wouldn't that help all Japanese companies? Why only the Nikkei?
Good question. It comes down to the business model. This extreme weakness is like pure rocket fuel for the massive exporters who mostly live in the Nikkei index. Well, think about it. They sell their cars or electronics overseas, right? They get paid in strong dollars or euros. Then they bring that money back home and convert it into a much weaker yen. So their reported profits, just on paper from the currency conversion alone, look huge.
Ah, okay. So the profits swelled just from the exchange rate.
Exactly. But the TOPIX index, which has more domestic companies operating mostly in yen, they don't get that same benefit, or at least not nearly as much.
So foreign investors putting money into Japan, they're not buying the whole ship, going back to our analogy. They're just buying tickets for that top deck.
Precisely. Foreign investors are being very selective, almost surgical. They're concentrating their money in Nikkei 225 futures or buying those specific stocks that benefit from Takaichi's policies. They're buying Nikkei tech and exports. They're not making a broad bet on Japan.
That really feels like the key takeaway here. You just can't think of Japan as one single market right now.
That's takeaway number one, absolutely. The Nikkei has basically become a proxy for global tech plus export winners, while the TOPIX is really Japanese domestic economy plus financials. You, as an investor, you have to decide which story you actually want to invest in.
And our sources were pretty clear that this extreme NT ratio, this 15.8 level, it's acting like a kind of fever gauge, like an overheating warning light.
Yeah, that's a good way to think about it. This level of concentrated gain, historically, it just doesn't tend to last. It definitely signals risk.
What kind of risks specifically?
Well, there are two main ones. Risk A is just policy disappointment. What if Takaichi's policies stall or the hype fades? Then those stocks that flew the highest, the Nikkei darlings, they could face a really sharp correction. A catch down, basically.
Okay, policy risk. What's B?
Risk B is intervention. If the yen gets too weak, weakens past some critical point, the government or the Bank of Japan might actually step in to strengthen it.
Right, they might intervene in the currency market.
Exactly. And if that happens, if the yen suddenly strengthens, that would immediately hurt those export stocks that have benefited so much from the weak yen, the yen-yasu.
Okay, so if the Nikkei looks potentially overheated and risky, does that mean there's an opportunity somewhere else? Like a contrarian play?
Well, that's the question, isn't it? The potential opportunity could be looking at that neglected ground floor, the 2PX stocks, especially domestic companies, maybe banks.
The ones left behind by the current rally.
Right. If Japan's actual internal economy starts to show real signs of recovery, or maybe if the Bank of Japan shifts its stance, becomes a bit less dovish, well, then money could rotate out of those hot Nikkei names and into these currently cheap domestic value stocks. They represent a different bet, a bet on Japan's internal recovery, not just global trade.
That Japanese situation really highlights how specific policies and currency moves can just completely reshape a market. Okay, let's zoom out now. What does all this mean for the bigger picture, this sort of shifting balance between the U.S. market and the rest of the world?
Yeah, it's a really interesting shift. I mean, for years, probably a decade or more, if you were a U.S. investor, you basically just rode the S&P 500, mostly driven by the magnificent seven-foot tech giants, right?
Right. Felt like the U.S. was the only game in town sometimes.
It really did. It was like this marathon where the U.S. was just miles ahead. But now, here in late 2025, we're starting to see some, subtle but important cracks in that U.S. lead.
How so? The AI rally seems pretty strong still.
The AI rally is still going, yes, but you're also seeing more volatility in the U.S. There are real questions cropping up about AI profitability. Who's actually making money from it yet? Think about Oracle's recent numbers, for example. Plus, you have political noise, potential shutdowns, tariff talk. It adds uncertainty.
Okay, so U.S. has some bumps. What about outside the U.S.?
Well, that's the interesting part. Non-U.S. developed markets are actually holding up, maybe better than people expected. We're seeing strength in certain areas, like European value stocks, and as we just discussed, those specific Japanese exporters benefiting from the weak yen.
So why are these non-U.S. markets starting to catch up now? What's driving that?
I'd say the main reason comes down to valuation. Just how expensive the U.S. market, particularly U.S. tech, has become compared to everywhere else.
Okay, but hang on. If the U.S. has all the big tech innovation, the Apples, the NVIDIAs, and we likely already own some of that, why should U.S. investors even bother looking at cheaper foreign markets that maybe don't have that same growth story?
That's a fair question. But that massive valuation gap itself creates a risk. What we're seeing is classic value rotation. Investors are looking at the very high price tag on U.S. assets and saying, okay, maybe the best returns from here aren't in the U.S. anymore. So they start looking for bargains overseas.
Hunting for value in cheaper markets.
Exactly. They're moving capital towards relatively cheaper, lower valuation markets, especially in Europe and Japan, because the U.S. market feels, maybe fully priced and The expected return going forward might be lower just because of that high starting point.
Makes sense. What else is helping non-U.S. markets?
The second big factor is currency, specifically the U.S. dollar.
Ah, right, the dollar's role.
Yeah, it's huge. For a while there was a strong expectation that the U.S. Fed would have to slow down its rate hikes, maybe even start cutting eventually. And typically that leads people to forecast a weaker dollar over time.
And a weaker dollar helps U.S. investors buying foreign assets.
Absolutely. If the dollar weakens, it means your foreign investments are worth more when you eventually convert those profits back into dollars. It's like getting an instant bonus or a discount on the way in.
Even though the dollar actually strengthened again recently in October.
Right, that offset things a bit in the short term. But that longer-term expectation of a potential dollar peak, or at least a slowdown, is still influencing how people position their portfolios globally.
So you combine potentially lower U.S. valuations, the dollar outlook, and then these specific regional stories like Japan's weak yen or strong earnings from certain European firms.
And suddenly the case for looking outside the U.S., for diversifying, starts to look a lot more compelling than it has for a while.
So what's the bottom line here for a U.S. investor hearing this?
I think the main takeaway is just how essential regional diversification really is. Relying only on the U.S., especially after such a long run, is getting riskier. This recent performance shows that things change, regional cycles turn, policies shift, currencies move. Diversifying, maybe using something simple like a broad ex-US ETF, VEA for example, it's key to smoothing out returns over the long haul and catching these shifts.
And that brings us to the other crucial point for investing overseas, currency. You mentioned it briefly, but it's huge, right?
It's absolutely huge. You said it earlier. Currency is half the battle. When you buy a stock in, say, Europe or Japan, your total return isn't just the stock price change. It's the stock price change plus the change in the exchange rate between the dollar and the euro or the yen. That currency move can either massively boost your return or wipe out your gains.
So you need a plan for that.
You absolutely need a strategy. The big question is, do you invest currency open? Meaning you take on that full exchange rate risk and reward? Or do you pay a bit extra to currency hedge, essentially locking in an exchange rate and removing that volatility? There's no single right answer, but you must decide on your approach.
And it gets complicated fast. I saw something in the notes about hedging costs being weirdly low in some places right now, like Korea.
Yeah, exactly. Sometimes temporary market conditions can make hedging unusually cheap, which can artificially boost the attractiveness of buying assets in that country on a hedged basis. It adds another layer you need to consider.
Okay, so diversify, manage currency, but there's a risk just chasing cheapness overseas, right?
Yeah.
The value trap.
Absolutely. Before anyone just rushes out and buys the cheapest looking market,
Mhm.
we have to talk about avoiding the value trap.
Right. What is that exactly? Confusing cheap with a good deal.
Precisely. The classic value trap is buying something just because its price looks low compared to its history or compared to other assets, but ignoring the reason it's cheap. Maybe the company has terrible debt, or its whole industry is shrinking, or it's in a country with major political problems or, terrible demographics.
So you buy it cheap.
And it just stays cheap, or it gets cheaper.
Yeah.
Becomes dead money in your portfolio because the underlying problems never get fixed. A low valuation is only attractive if there's a reasonable chance things will actually get better.
So you really have to dig into the fundamentals, look at the actual risks, political instability in France maybe, or Germany's structural issues, or Japan's debt and aging population that we know about. Don't just look at the price tag.
Exactly. Analyze the risks versus the potential reward. Is it cheap for a good reason or just cheap? Otherwise, you might just end up buying a stock that, frankly, deserves to be cheap.
Okay, let's wrap this up. We've covered a lot of ground. Two big global shifts needing your attention. First, Japan. It's really a tale of two markets right now, split wide open by government policy bets and that super weak yen. High risk, maybe high reward, but you need to know what you're buying.
Right. Nikkei is not 2PX.
Exactly. And second, globally, the tide might be turning a bit. After years of U.S. dominance, non-U.S. developed markets are showing relative strength, driven by valuations, currency expectations, and specific regional factors. It really underlines the need for diversification.
And managing that currency risk actively.
Definitely. So final thought.
I think the big picture is that this environment demands investors focus on managing risk, not just blindly chasing returns. For you, the U.S.-based investor, the real question is becoming, how much concentration in U.S. big tech are you comfortable with? At what point does the argument for diversifying into potential turnarounds or simply undervalued assets outside the U.S. become too compelling to ignore? That whole diversification and currency strategy conversation is getting more urgent.
Lots to think about there. Don't forget to subscribe and hit that like button.